Hey there, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into Next Level Charting. Thank you very much for joining us. I appreciate it. If you're watching this video on YouTube, and you like it, of course, please give us a thumbs up and consider subscribing. Today we're going to dive into seasonal patterns, and this is pretty interesting because we saw some weak seasonality in February, and that's when a lot of the high flyers peaked and started declining. Then we had some mixed seasonality in March, but bullish seasonality in April, and April was a very good month. And now we're heading into May, June, and July. And so what I want to do is I want to look at the best and worst 6-month periods. That's a very famous seasonal study, and we'll show you how that works. And then we're going to show you monthly seasonality, month per month. And then I'm going to show you what I think we might expect in May, June, and July. So I am here on my members page at StockCharts, and I want to show you the seasonality tool here. If you can't find it, if you're not a member, then you can go to the Charts and Tools page, and there you will find the seasonality link. And so if you look under your member tools, there is seasonality. And if we click on that, the default's going to be a seasonality chart for the Dow Industrials there. And I'm going to switch this out to the S&P 500. You could look at oil, you could look at gold, you could look at bonds, you could look at whatever you want as far as seasonality is concerned on this chart. And it gives you a real nice overview of what the patterns are over the years. So I'm going to use that slider and open it up to 20 years. That's the max. And you can see right away 2 months stand out. We have April at 80% of the time it is up, and November 79%. And then the other two would be December and July of all months. So those are the top 4 months. And then you can see the weakest month is January. And then after January, we've got weakness in June and September. So if you think about this 6-month period that I'm talking about coming up here, part of the 6-month period is going to be November, December, and April. Now, at the bottom, we've got the average move for the 20-year period, the gain-loss. So the average gain-loss was a 2.4% gain in April, and in June, it was a 0.5% loss. So some weakness coming in June. Now, I wrote an article on seasonal trends for the S&P 500, the best and worst 6 months, and I broke it down per month. And then I took it one step further, and I look at the equity curves for each month and for the best and worst 6 months. So this is like you're trading that strategy. Say you would only be long the month of May. Well, what would that equity curve look like as far as profit and loss? And that gives us an idea of how a month trends over a 25-year period, because I went back to 1996. And so this is the main analysis page at Trend Investor Pro, and there's a mix of paid and free commentary. And there you can see a free commentary around once a week, twice a week sometimes. I put up a free article. Semis were losing their shine. That was the article on Friday. So if we go over to this article on the seasonal trends here, I'm going to start off with the best and worst 6 months. And this was popularized by Yale and Jeffrey Hirsch of the Stock Traders Almanac. And there's a link to that in the article. Also, you can see it right here. It's stocktradersalmanac.com. They do great work over there. The almanac is something you just need to have on your desk, and you need to take a look at it at least once a week to see what's coming up. So here we have the performance for the best and worst 6 months. And so the best 6 months goes from November to April. And you can see there are the 2 biggest months, November and April, at either end of that period. So that's probably a big reason this is the best 6 months, because of those 2 months. And then you get sell in May and go away. The worst 6 months, May to October. And so if we treat this as a portfolio, say we're only going to buy or we're going to own from November to April, and we're not going to own, we're just going to sit out the other 6 months. Well, you would have a maximum drawdown of 32% if you bought the S&P 500, 20 wins and 25 losses, an 80% win rate, an average gain of 10.5%. The average loss was still pretty big, but there were only 5 of them. And you got a profit factor of 5.59. That's huge. And so profit factor is the total dollars from the gains divided by the total dollars from the losses. It's like your ex post reward to risk ratio. And you want that to be above 2 because that means you're making twice as much on your winners as you are losing on your losers. So for a single trade, say you make $1,000 on a trade and you lose 500 on the next, well, your ex post profit factor would be 2 because it'd be 1,000 divided by 500, which is 2. So anyhow, if you look at the worst 6 months, drawdown gets up to 40%. Wins, losses, 65% win rate. It's less, but it's still a win rate that's positive. But your average loss is bigger, and your profit factor is 1.43. So clearly there's an edge from November to April relative to May to October. And then if we look at this on the equity curve here, the blue line is buy and hold for the S&P 500. So you can see here that, the S&P 500 was underwater here with that 2008 low. Well, it was below that 2002 low. So it was a rough patch here. And then on the 6-month strategy, you can see it was not immune, the best 6 months, it was not immune to market weakness. And then when the market took off, the best 6-month strategy performed well, and it continued to perform well, but didn't outperform the market. But it was only invested half the time, 6 months. But it wasn't immune to volatility either. You can see that volatility that started in 2018, well, it's still there if you're trading that 6-month cycle, the best 6 months. Well, it's seasonality, not really cycle. So what does the worst 6 months look like? Well, you can see it doesn't look as good, but man, it's been on a tear since 2012. So, you see it goes up, and then you have the 2000, 2001 bear market, and so you get hit really hard, and you work your way back up, and then you have the 2008 bear market, and you get to almost a new low. But, in 2011, this is clearly the worst 6 months. But look what's happened since 2012. The worst 6 months has been performing quite good. It's not keeping up with the best 6 months. I tested it from 2012 onwards, and the best 6 months is still outperforming the worst 6-month period. So now we're going to break it down by month. And how does each month perform as a portfolio? So say I'm only going to own the S&P 500 during the month of January and not own it any other month and see how that performance is. And that way we can compare each month. And so I've highlighted 3 months in red and 3 months in green because they stand out. It's similar to what we saw on the StockCharts seasonality chart. February is clearly a weak month. Profit factor is below 1. Drawdown 28%. Win rate 58%. Then you look at August and September. Drawdowns above 24%. You can see profit factors below 1. So August and September are weak months. 56% of the time they were up, so it's 50-50 on up or down, but a negative bias on the downs. And then on the positive side, again, April, November, and December. And then one more here that kind of jumps out is June. You can see June had a 22% drawdown, and it was up 64% of the time, but its profit factor was barely positive, 1.01. So this is how it looks on the surface at the end of the 26 year counting, because some of them have 26 years, the months we've already had, and then the months that have yet to be played out only have 25 years, and those will be added on. So what I think we need to do is we need to look at the equity curves for each month to see how that month has been playing out. In other words, what is the trend for that seasonality pattern? So as I said, I'm going to focus on May, June, and July first, and then we'll see how many of the other months we can get through. But this is the equity line. So you start with $100,000, and each month of May you buy, and you can see it's going up those 2 months. And then it goes down, it goes down, it goes down in the next months for May over the next 3 years. And then we had this big run up from 2003 until 2008. And then in 2009, we have a big move down, actually 2010. That's the flash crash. And then 2012, that's the European sovereign debt crisis. Big moves down. And then 2019 went down 6%. And that was on issues related to Chinese trade with China. So you can see over the last 11 years, May has experienced a decline greater than 6% 3 times. May has been a pretty rough year. And then if you look at this equity curve from 1996, you know it's up, it's down, it's up big, it's down big, it's up, it's down, it's up. So May is just all over the place. You know, this is not an equity curve that's going from the lower left to the upper right. And so that tells me that May could be a rough ride, judging from this equity curve. It's not as positive as the stats would suggest they are when you look at the seasonality chart on StockCharts or when you look at the data that I presented here. You know, you can see that May is up 62% of the time and the profit factor is 1.21. Well, that seems pretty good. But then when you look at the equity curve here, you can see that, well, really May is just all over the place. And so let's look at June. Does June look any better? Well, June started out good in the 90s, and then in the 2000s, all the way from 2000 to 2011, had a really rough patch, and then went nowhere. And then June 2019, we were up 6.9%, and that was after that big decline in May. So who knows what was going on there. But overall, you know, this is a weak equity curve. It's up, it's down, it's up. It's not moving from left to right to the upper right. It's not in an uptrend. It's more all over the place. So it's a coin flip at best. And I would say there's not much bullish seasonality in May or in June. And that is working against the market right now. So here is July, and July looks a lot different than May and June. So if you look at July, it started off rough from 98 until 2008. But since 2009, July's been a very good month for the S&P 500. So that suggests that maybe we're going to have a rough patch in May and June, work off some overbought conditions. And then if we get a bullish setup and we break out in July, it's going to have this bullish tailwind that the month of July has had over the last 10 years. And then we're going to hit August, and August is a pretty weak month. And you can see that chart, of course, if you subscribe to Trend Investor Pro, because it is shown further below. So if you'd like to know more about trendinvestorpro.com, you can click on the link below in the description. Again, if you like this video, please give us a thumbs up and consider subscribing to StockCharts. Thanks again for tuning in. Have a great day, and I'll talk to you again next week.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.